The year started with a promise. Mortgage rates were drifting down. The 30-year fixed averaged 6.04% in February. Credit card borrowers were told relief was coming. Rate cuts were the consensus. Then on March 27, 2026, the promise broke. For the first time in this entire rate cycle, futures markets priced a Federal Reserve rate hike as more likely than a cut. 52% probability, not a reduction, an increase. In a single month, the average 30-year mortgage climbed from 6.04 to 6.49%. Gasoline crossed $3.98 a gallon, and the institution that was supposed to make borrowing cheaper just became more likely to make it more expensive. Let me show you how this happened and what it means for every dollar you owe. The Federal Reserve operates under what is called a dual mandate. Two jobs assigned by Congress in 1977. Job 1, keep prices stable. Job 2, keep Americans employed. For most of the past 5 decades, those two goals moved in the same direction. When the economy overheated, the Fed raised rates. Prices cooled, hiring adjusted. When the economy weakened, the Fed cut rates, credit loosened, businesses expanded. The machine worked because the two mandates rarely pulled against each other. An oil shock tears that alignment apart. On February 28, 2026, the United States and Israel launched coordinated airstrikes against Iran. Iran retaliated by closing the Strait of Hormuz, the narrow waterway that carries roughly 20% of the world's seaborne crude oil. Brent crude went from $67 a barrel in early February to $112 by March 27th. 67% in under 30 days. That is the fastest oil price surge since the 1970s embargo. Follow the chain. Oil prices feed directly into gasoline, diesel, jet fuel, shipping costs, and petrochemical inputs. Those costs ripple outward into everything that moves, everything that gets packaged, everything that gets manufactured. The Bureau of Labor Statistics reported that import prices jumped 1.3% in February alone. That was the largest single-month increase since March 2022. And here's the critical detail. That shock has not fully reached consumer prices yet. It takes 6 to 12 weeks for an import price surge to work through supply chains and appear on store shelves and service invoices. The worst of it is still in the pipeline. That is not speculation. That is how supply chains work. So the Fed faces an inflation problem that refuses to resolve. Core personal consumption expenditures, the gauge the Federal Reserve watches most closely, registered 3.1% in January, a full percentage point above their 2% target, and the highest monthly acceleration in core prices since the summer of 2024. The February reading, due April 9th, will carry the first wave of the oil shock inside it. Here is the other side of the trap. The economy lost 92,000 jobs in February. Not a slowdown, a contraction. It was the third month of net job losses in 5 months. The entire year of 2025 produced just 181,000 jobs, revised down from 584,000. That is roughly 15,000 per month, not enough to keep up with population growth, functionally zero. Think of the Fed as a driver trying to push a truck up a steep mountain road while the engine is already overheating. If the driver presses harder on the gas, the truck keeps climbing, just as cutting rates and adding liquidity can keep the economy moving. But the engine runs even hotter, just as inflation can flare back up. If the driver eases off, the engine cools, just as holding rates high can cool inflation. But the truck loses momentum and risks stalling on the incline, just as the economy risks slipping into contraction. That is the trap. Every move relieves one pressure by worsening the other. There is no safe pedal position left. And here is the part most people miss. Everyone watches the Fed's benchmark interest rate, but your mortgage rate is not set by the Fed. Your mortgage rate is built on two things: the yield on the 10-year Treasury bond, which moves with inflation expectations, and a spread on top of that, the premium lenders charge for risk and uncertainty. When oil sends inflation expectations higher, the yield rises and your baseline mortgage cost rises with it. When the Fed is paralyzed, when markets cannot determine whether the next move is a hike or a cut, when nobody knows who will be running the institution 6 weeks from now, lenders widen the spread to protect themselves. Your borrowing cost gets hit from both directions. The inflation pushes the floor up. The paralysis pushes the ceiling up. And because the Fed cannot move, there is no one left to push either one back down. The old playbook assumed that weaker demand would eventually cure inflation on its own. Consumers spend less, businesses pull back, prices soften, the Fed gets room to cut. But this cycle broke the playbook. Inflation now survives through channels that weaker spending alone cannot shut down. Count them. Oil prices are set by geopolitics, not by how much Americans drive. Shipping insurance is set by whether tankers get hit, not by how shoppers feel. Your rent still carries the landlord's price increase from last year because leases lock in old costs long after the economy has slowed. Tariffs raise the price of making things regardless of whether demand is strong or weak. And the war in the Middle East injected all of these pressures at the same time, building a floor under prices that the economy cannot break through by simply cooling off. The result is something no one in charge wants to say out loud: an economy that can slow down and still feel expensive at the same time. The Fed cannot move, and every month it stays frozen. The price of every dollar you borrow ticks higher. Now here is where most people make a mistake in their thinking. They hear the word stagflation and immediately picture the 1970s. Gas lines stretching around the block, unemployment in double digits, Paul Volcker raising rates to 20% to break the spiral. They look at today, see 4.4% unemployment and 2.4% consumer price inflation, and conclude the comparison simply does not hold. That reaction is exactly what makes this moment dangerous. Classic stagflation in the 70s arrived as a headline event. One massive oil embargo, one unmistakable crisis, one clear villain. This version does not announce itself. It accumulates. Shelter costs stayed elevated at 3% year over year through February. Services inflation never fully normalized. Insurance kept repricing quarter after quarter. Medical costs climbed. Transportation costs climbed. Utilities and repairs climbed. None of these created one explosive spike. But together they kept the cost structure heavy enough to prevent the relief that was supposed to arrive after the post-pandemic inflation surge. People do not experience the economy as a gross domestic product number. They experience it as breathing room. Can you absorb an unexpected car repair without going into debt? Can you refinance a loan at a rate that actually saves money? Can you replace a vehicle without draining your emergency fund? Can you cover rent, insurance, and minimum payments without deciding which bill gets delayed this month? When growth is slowing but prices stay sticky, that breathing room vanishes quietly, month by month, without a single headline to explain why life still feels hard. The breathing room is gone, not because one thing broke, because nothing fully healed. The Federal Reserve has been in this trap before. And the lesson it left behind should terrify anyone paying attention. In 1973, Arthur Burns was chairman of the Fed when the Arab oil embargo hit. Crude prices quadrupled in months. Burns faced the same impossible choice the current Fed faces now. Inflation was surging from supply disruption. The economy was weakening from the same shock. His response became a case study in what not to do. He raised rates, watched unemployment climb, lost his nerve, and paused. Then he tried raising again, then paused again. Stop and go. Each time he blinked, markets concluded the Fed would always blink. The damage compounded with every reversal. Inflation expectations embedded themselves deeper into every wage negotiation, every price decision, every long-term contract signed across the country. Workers demanded higher pay because they believed prices would keep rising. Businesses raised prices because they believed costs would keep climbing. Nobody trusted the Fed to hold the line, and so the psychology of inflation became more powerful than the inflation itself. It took Paul Volcker, who replaced Burns in 1979, to end the spiral. His method was brutal, and it was deliberate. He raised the federal funds rate to 20%. Unemployment reached 10.8%, the highest since the Great Depression at that time. The economy suffered 2 recessions in 3 years. The cure worked. But the cure required deliberately inflicting the worst economic pain a generation had experienced. On March 18, 2026, Jerome Powell stood at a podium and brought up the Burns era by name. He admitted his 2 jobs were pulling in opposite directions. And then he told reporters he would reserve the word stagflation for a much more serious set of circumstances. 9 days later, the futures market priced a rate hike as more likely than a cut. Powell says the word does not apply. The market is betting the trap has already closed. You might be thinking, at least we are not in a recession. Growth is still positive. The system is bending, not breaking, and that is fair. But bending is precisely the problem. In a recession, the Fed has clear permission to act, cut rates aggressively, flood the system with liquidity. Nobody questions it. A recession gives the central bank cover to move. This environment does not. Growth is too weak to celebrate and too strong to justify emergency measures. Inflation is too high to ignore and too low to declare a crisis. The economy is stuck in a corridor where every option carries damage and nothing is dramatic enough to force a clean decision. That is not patience, that is entrapment. So let me prove the trap with numbers. 5 data points. Same question after each one. The American economy grew at 0.7% in the final quarter of 2025. To put that in terms you can feel, the entire country's output expanded by roughly $600 per household for the quarter. Not per month, for the whole quarter. 1 quarter earlier, growth was running at 4.4%. That is not a gradual slowdown. The economy went from expansion to near standstill in 90 days, dragged down by a government shutdown, weaker exports, and fading consumer momentum. The textbook response is obvious. Cut rates, stimulate spending, get growth moving again. But the Fed cannot move. Because core inflation is a full point above target and still climbing. Non-farm payrolls fell by 92,000 in February, and it was worse than anyone on Wall Street expected. Forecasters had predicted a gain of 59,000. Instead, the economy shed jobs for the 3rd time in 5 months. Healthcare, the one sector that had reliably added jobs through the entire slowdown, lost 28,000 positions in a single month, largely because of a Kaiser Permanente strike that sidelined more than 30,000 workers. Manufacturing shed 12,000, transportation dropped 11,000. Federal government employment has fallen by 330,000 since October 2024, an 11% reduction driven by workforce cuts. And December payrolls were revised from a gain of 48,000 to a loss of 17,000, which means what the government initially called job growth was actually job destruction. Over the past 6 months, the American economy has created essentially 0 net new jobs. That is not a soft patch. That is a labor market that has stopped moving. So ease policy and protect employment. The Fed cannot move. Because easing into an import price surge would pour fuel on a fire already burning. Core personal consumption expenditures hit 3.1% in January, the latest available reading from the Bureau of Economic Analysis on March 13th. The monthly increase was 0.4%. Annualize that pace, and you get nearly 5% core inflation. That is not a number that is cooling. That is a number gaining speed beneath the headline. So hold rates firm and fight inflation. The Fed cannot move, because holding at 3.5 to 3.75% while growth prints 0.7 risks, pushing the economy into outright contraction. The University of Michigan surveys how Americans feel about the economy. It has been running for over 70 years. The final March reading came in at 53.3. Only 1% of all readings in the survey's history have ever been lower. That is not pessimism. That is a consumer base pulling back from the economy in real time. So reassure markets and signal stability. The Fed cannot move, because the same survey showed 1-year inflation expectations surging to 3.8%, the highest reading since the war began. Here is why that second number matters more than the first. That reading means American households are starting to believe prices will keep rising no matter what the Fed does. There is a word for that in central banking, unanchoring, and it is the one outcome every Fed chair fears most. Once expectations break loose from the target, they feed themselves. Workers demand higher wages because they see higher costs coming. Businesses raise prices because they see higher inputs coming. The cycle locks in, and the only proven tool to break it is aggressive rate hikes. But aggressive rate hikes into an economy growing at less than 1% would trigger exactly the recession the Fed is trying to avoid. 5 readings, 5 walls, one institution pinned between all of them. If this is connecting, hit subscribe. The data releases in April will test every line of this analysis, and you will want context the day they land. Here is where the paralysis stops being a policy debate and starts showing up in your actual life. Start with the biggest number most Americans owe, their mortgage. In February, the average 30-year fixed rate sat at 6.04%. By late March, it had climbed to 6.49. That gap, roughly half a percentage point, sounds small. It is not small. On a $400,000 mortgage, that half point adds roughly $120 to your monthly payment. Over a year, that is nearly $1,450 gone from your household budget. And it came from 2 directions at once, exactly the way the mechanism works. Oil-driven inflation pushed bond yields higher, which dragged the baseline cost of mortgages up with it. And the Fed's paralysis widened the premium lenders' charge on top, because when nobody knows whether the next move is a hike or a cut, banks add a cushion to protect themselves. You pay for both. the inflation you did not cause and the uncertainty you did not create. And because the Fed cannot move, nobody is pushing either one back down. If you were waiting to refinance, the window is narrower than it was in January. The 30-year refinance rate reached 6.97% by late March. At the start of the year, it was trending below 6.5. Every week, the Fed stays frozen. That window shrinks further, and the savings millions of homeowners were counting on evaporate in real time. The window that millions of homeowners were waiting for, the chance to lock in a lower rate and reduce their monthly burden, is closing week by week. Every day the Fed stays frozen, the spread widens, and the opportunity shrinks. Credit cards absorb the same paralysis. You might think credit card rates are a separate issue, set by banks and card companies based on their own risk models. That is true in theory. In practice, the floor is set by one number. The average credit card annual percentage rate sits above 20%. That rate is mechanically linked to the prime rate, and the prime rate equals the Fed rate plus 3 percentage points. With the Fed holding at 3.5 to 3 3/4, the prime rate is locked at 6.5 to 6 3/4. That floor holds up every variable rate card in the country. 170 million American credit card holders are paying a premium not because the economy is booming, but because the Fed is frozen. And unlike a mortgage, which you can choose not to take, credit card debt often accumulates involuntarily through emergencies, medical bills, and the slow erosion of savings that a stagflation-light regime produces. Auto loans complete the picture. The average rate on a new vehicle loan runs close to 7%. The average transaction price for a new car just crossed $49,000. Even with a down payment, most buyers are financing north of $40,000. At 7% over 5 years, that means more than $8,000 in interest alone. That is the price of borrowing during a period when the central bank cannot reduce the cost of money. And sitting beneath all of these numbers is a leadership vacuum that compounds every layer of uncertainty. Jerome Powell's term as Federal Reserve Chairman expires May 15, 2026. President Trump nominated Kevin Warsh to replace him. Warsh has not been confirmed because Senator Thom Tillis of North Carolina has been holding up the process. Powell told reporters he will remain in place until his successor takes the oath. The Federal Reserve is entering the most consequential policy window since 2008 with a lame duck chair, no confirmed replacement, and a bond market that prices every day of institutional doubt into the spread on your home loan and your car payment. The breathing room is gone, not because of one dramatic rate hike, because certainty evaporated, and uncertainty has a price that compounds every single month. So what do you watch? 5 numbers, 5 thresholds. Each one tells you whether the trap is tightening or loosening. First, core personal consumption expenditures for February, released April 9th. If it prints above 3% for a second consecutive month, rate cuts are functionally dead for 2026. Your mortgage stays expensive. Your credit card rate stays locked. The Fed will not move until this number drops below 2.7 and holds there. Second, the March employment report released April 3rd. If non-farm payrolls come in negative for a second straight month, that is not a soft patch. That is a recession signal. Banks respond to recession signals by tightening lending standards. Approval gets harder. Rates for riskier borrowers climb higher. The cost of credit rises even without a Fed hike. Third, the University of Michigan 1-year inflation expectations in April. If that number crosses 4%, the Federal Reserve faces a credibility emergency. Unanchored expectations would push the institution toward hiking into weakness. A rate hike into an economy growing below 1% would be a direct hit to employment, housing, and consumer spending at the same time. Fourth, Brent crude oil. If it stays above $100 per barrel through April, the inflation pipeline remains pressurized. Every week, crude holds triple digits, input costs ratchet higher, and the case for rate cuts grows weaker. Watch for whether the Strait of Hormuz begins reopening. Trump extended the deadline to April 6th. If the strait stays closed past that date, oil stays elevated and the Fed stays pinned. Fifth, the 10-year Treasury yield. This rate most directly shapes what you pay on a mortgage. If it crosses 4.5% and stays there, 30-year mortgage rates head towards 7%. At 7% on a $400,000 loan, your monthly payment reaches $2,661. At 6%, it would be $2,398. The gap is $263 every month. $3,156 every year, and you have no vote in that number. Watch those 5 in April. They will tell you more about your financial future than anything a Fed official says at a podium. Because the podium is where they explain what they wish they could do. The numbers are where you see what they actually cannot. Here is where this lands. The economy did not crash. It shifted. It entered a regime where growth weakens, but costs refuse to retreat fast enough for the central bank to act. Not a headline catastrophe. Not the dramatic unraveling that makes for good television. Something more corrosive. A slow grind where the institution designed to protect your purchasing power and your employment cannot serve both missions at once. The system keeps moving, but the people inside it keep losing ground. Powell said the word does not apply. 9 days later, the market disagreed, and the market has a way of being right about the thing policymakers are not yet ready to admit. You are not waiting for a crisis to arrive. The regime has already shifted underneath you. If core inflation stays above 3%, the Fed cannot cut without reigniting the price spiral that took 2 years to partially contain. If payrolls stay negative, the Fed cannot hold without deepening the employment damage. If oil stays above $100, both pressures intensify simultaneously. And if expectations cross 4%, the institution that is supposed to anchor prices may be forced to hike into an economy already on its knees, repeating the exact mistake Arthur Burns made half a century ago. Every path leads to pain. The only variable is which pain and when, so the choice is not complicated. Either you understand that trap and position before April's data arrives, or you keep waiting for a rescue that requires a freedom the Federal Reserve no longer has. The Fed still has tools. What it no longer has is freedom. If this changed how you see the economy, subscribe now. Drop a comment telling me which of those 5 numbers you are watching, and send this to someone who is still counting on rate cuts to save them. The breathing room is gone, and it is not coming back on schedule.